direct method. So again, we don't start with net income, we start right from scratch, okay? So we'll go, okay, cash receipts from customers to start. Equals cash receipts from customer. Okay, so instead of starting with net income, okay, we want to know what did we get from our customers. Okay, so the first thing that you'd have to look at is that we'll start with sales revenue first. So just down below, I'll do the sales rev, plus,
So direct method used for small company?
Is it used for smaller companies? No, just nobody uses it.
Oh,
Yeah.
really? So why are we studying this?
Why are we studying? That's why I said I'm not going to test on it, but the course itself is CPA accredited, so theoretically I have to teach it. Okay, so that's why I'm just showing it to you. If you want to zone out for the next 15 minutes, that's fine. Okay, but it's kind of nice to have an idea at least. So if someone says, oh, the direct method, then at least you know what you're talking about, right?
Right.
Okay, but again, yeah, no, typically it's more complex. It gives more information to investors. That's why IFRS likes using it. But they give you the option between the direct and the indirect, and everyone chooses the indirect because it discloses less information to their competitors, okay, and then it's easier to do as well, so they spend less time doing it. So kind of a win-win for the indirect. So that's why, like, even in my intro course, they don't show the direct method. If you get to like an intermediate and like advanced accounting, I think in intermediate 1 they show both methods. Okay, but again, okay, it's really up to you however you want to do it. But so we'll start cash receipts from customers. So we'll start with revenue. Okay, so we've got 605,000 of revenue. Okay, and then we have to look to our accounts receivable as well. Okay, so our accounts receivable decreased from 135 to 120. Okay, so that means that we've received an additional $15,000 on top of that revenue.
And then after.
Okay, so 605 plus the 15,000 accounts receivable. Okay, our cash from customers is 620,000. Okay, so again, that comes from if we sold $605,000 worth of goods. Okay, and then our accounts receivable decreases by 15,000. That means we've collected an additional $15,000 on top of our 605,000 because our accounts receivable didn't increase, but we sold $605,000 worth of stuff. Okay, so we know that it's at least 605,000. AR goes down by 15,000. That means we've collected an additional 15 grand, of cash from our sales. Okay, so again, that's what I said. This method is not my favorite, but the next one is even worse. Okay, it's cash paid to suppliers is next. Okay, so our cash paid to suppliers. Okay, we'll look to our income statement first. Okay, when we purchase inventory, we usually purchase from one of our vendors, aka our suppliers. So we'll start with cost of goods sold because that's the cost of our inventory that we purchased that we sold. Okay, so cost of goods sold is what, 265?
Yes.
265,000. Okay, next up.
and AP.
What's that? Yeah, so the corresponding amount for cost of goods sold. Okay, what is cost of goods sold related to?
AP.
Inventory, right? So then we got to go to the balance sheet here. Okay, look at inventory. Inventory went from 176 to 210,000. Okay, so that means we've spent an additional 34,000. Okay, so again, inventory is going up, means we spent more cash. Okay, so inventory. 34,000.
Yes.
Okay. Next up, this is to all our vendors and suppliers. Okay, so we've got utilities expense next. Okay, so utilities, we can see we spent 20 grand on utilities. Okay, and on our balance sheet, we don't have utilities payable or anything like that, so we know, okay, we essentially paid $20,000 in utilities, so we know that that cash just came out. Okay, next up, okay, another vendor is our landlord. Rent expense was 15. Okay. Okay, and then lastly, okay, our account payable went from 65,000 to 80,000. That again is usually tied to our suppliers. Okay, usually paying for inventory or supplies or whatever type of goods we have. Okay, so it goes from 65,000 to 80,000. Okay, so that's a cash decrease. Okay, so accounts payable, okay, that would be a minus 15,000. Okay, see why it's not the preferred method. Okay, so that net amount should be, okay, cash paid to suppliers, 319,000. Okay, so again, that's what you gotta look at. Okay, the expenses and then the change in the payable or the asset as well. Okay, to see the changes.
Account payable, is that?
Yeah, accounts payable, that's a subtraction of 15,000 because our payable increased, meaning that that cash hasn't came out. So we would decrease by 15,000. Because we actually, if our accounts payable increases by 15,000, that means we haven't paid our suppliers $15,000. If we recognize the expenses, then we have to take $15,000 out of cash paid to suppliers. Okay. Okay, that's pretty much the worst one. Okay, the next one is cash paid to employees. Okay, so where do we think we would look for that one? Right, wage expense, 50 grand. Do we see any wages payable or anything like that? No. Okay, I don't see anything. Okay, so we can go, okay, wage expense. Okay, 50 grand. Okay, again, no payable for the wages, so that means we've spent $50,000 of cash. Okay, so we can go $50,000 decrease. Okay, for our employees. And then we've covered so wages, utilities, okay, depreciation's a non-cash amount, we can forget about that. We've covered rent, okay, and now we've got interest expense again. Okay, we can go ahead and recognize that one, so that would be, okay, cash paid to interest. Interest, there we go. Okay. Okay, it was $9,000. Okay, so we see $9,000 interest expense. Do we see anything on the balance sheet? No, no interest payable or anything like that. Okay, so we can go ahead and put a $9,000 decrease, okay, there. Okay, so that covers sales, cost of goods sold, all of our expenses, okay, and then all the operating sides. So we've covered accounts receivable, okay, that was with our sales revenue. Inventory was with our suppliers, same with our accounts payable, okay, dividends, loans, anything else that's considered financing or investing. Okay, so that's covered everything. So if we go 620, okay, subtract 319, subtract 50, subtract 9,000, okay, we should get, okay, the exact same amount as our cash flows from operating from our indirect method. Okay, so again, you're not going to get a different amount, you're just going to have a different way of doing it. Okay, so either way that you do it, okay, you should end up with the same amount. And so for some reason, if you had an extra hour on the midterm, you wanted to double check your indirect method, you could do the direct method and see if it matches. Okay?